The private credit boom that defined the post-2008 era, one that made billionaires of the managers who ran it, is showing visible structural strain. Simultaneously, the Gulf's sovereign wealth ecosystem is undergoing a quiet but consequential repositioning. These two forces are converging on a single opportunity: litigation funding. This is not a niche observation, it is the direction of institutional capital. For over a decade, private credit was sold to high net worth investors on a compelling proposition: higher returns than public bonds, lower volatility than equities, and access previously reserved for institutions. The pitch was success. The small print was liquidity. That small print is now being read loudly by investors who want their money back. In March 2026, Apollo Global Management capped redemptions from its flagship private credit vehicle after investors sought to withdraw over $1.6 billion. Apollo honored just under half of those requests. Morgan Stanley and BlackRock made similar moves. Blue Owl Capital, a firm that grew its assets more than sixfold since 2021, has permanently halted redemptions from its first retail-focused private debt fund and begun liquidating it. Investors across the sector have submitted over $11.7 billion in redemption requests. Only 66% has been met. This is not a market wobble. It is a structural reckoning with a fundamental mismatch between illiquid assets and investor expectations of access. For high net worth investors who entered private credit seeking stability, the experience has been jarring. The promise of quarterly liquidity has collided with the reality of illiquid underlying assets. There is a second equally important force reshaping the capital landscape: the repositioning of Gulf sovereign wealth. For years, Middle Eastern sovereign wealth funds, the Saudi Public Investment Fund, the Qatar Investment Authority, the Abu Dhabi Investment Authority, have been among the most significant allocators into global private capital. Sovereign investors channeled over $140 billion into the US economy in 2025 alone. Gulf Cooperation Council deal volume grew 170% year on year. But the geopolitical context has shifted. The ongoing conflict involving Iran has introduced a new variable into Gulf capital planning: domestic reconstruction priorities, economic diversification goals, regional political recalibration. All of these are influencing how and where sovereign capital is deployed. At the same time as Apollo was managing its redemption backlog, Fortress Investment Group, one of the most sophisticated names in alternative assets, was committing $125 million to expand its litigation finance business. Fortress's legal assets unit has deployed approximately $7 billion in investments over 14 years. This is a considered long-term institutional position. The logic is structural. Legal outcomes are determined by courts, not central banks. The return profile of a funded case is not correlated to whether the Federal Reserve raises rates. It is not affected by whether a software company's revenue justifies its debt load, or whether sovereign wealth funds are focused on domestic reconstruction. A case either settles or it does not. The independence is the asset. Litigation funding returns are generated by legal outcomes, not market conditions. In an environment where credit cycle risk is rising and correlation is everywhere, genuine non-correlation has a meaningful price. Periods of institutional reallocation are historically when the most durable wealth decisions are made. The investors who moved into private credit in 2012 and 2013, when bank lending had retrenched and the opportunity was structural, did extremely well. Those who entered at the peak of the cycle are now the ones submitting redemption requests. For high net worth investors in Hong Kong, Singapore, and the UAE, who have built portfolios around private credit allocations, this is a moment worth pausing to examine. The question is not whether litigation funding will become a more significant part of sophisticated portfolio construction. It already is. The question is whether individual investors will position themselves ahead of that shift or spend the next 2 years watching institutional capital take the seats. The world's smartest money does not wait for consensus. It moves when the logic is clear and the window is open. That window is open now. If you found this analysis useful, please subscribe for more insights on alternative investments and capital strategy. And to learn more about Carey Suen's litigation funding structures, visit careysuen.com.